Good afternoon, financial advisors, and welcome to another edition of The Brew, where we build relationships every week. Thanks for tuning in with us today. For those of you joining us for the first time, we like to start the Brewcast by celebrating today's national days. We're going to begin with the first one. Today's National Banana Day. Everybody knows about bananas, low-calorie fruit, full of vitamins and minerals. Packs a great nutritional punch. Portable, very easy to eat. They've also been a comedic staple since forever. I'm not sure why. I'll leave that for you to decide. But here's a quick piece of trivia about bananas. What is a group of bananas called? Before you go rushing to Google, I'll just tell you a cluster of bananas on a tree is called a hand. Maybe because they look like a hand, I'm not sure. In any case, bananas, they've got appeal. Speaking of nutritional things, today is also National Garlic Day. Garlic is known as the stinking rose. Garlic is a member of the lily family of plants and has been used for thousands of years for its nutritional and medicinal benefits. Even if you don't love garlic in your food, it's good to keep some around to ward off the vampires and werewolves. And lastly, today is, and I have to say it, National North Dakota Day. Why? Because today is celebrating the day where E4's as a company is headquartered in Fargo, North Dakota. So we couldn't let it go without a mention. I will say that while many of the license plates in North Dakota remind us that North Dakota is legendary, I think the license plate should read, "You must be lost." Just kidding. Today, we're going to welcome Mike Pinkans back to the Brew. Mike's going to be sharing with our attendees exactly how to use qualified money to fund a linked benefit long-term care policy. Additionally, Mike's going to explore the possibility of how clients can receive a 25% bonus on the qualified assets used to fund the contract. Before we get started, feel free to use the chat box to share your thoughts and ask questions. Also, all attendees are in a drawing for a CE voucher and a Starbucks gift card. We'll be announcing the winner at the end of the program. Mike, welcome back to the Brew. As I just mentioned, you're going to be talking to us about how to use qualified assets to purchase linked benefit long-term care. But before we get to your ideas, let's back up a little bit and talk about why is long-term care or even having a long-term care discussion important?
Well, thanks, John, and it's good to be back on the Brew. I'm still processing today has been celebrating Banana Day and North Dakota Day, but why are we having a discussion about long-term care? I turned 60 this year, so life has gone pretty fast, and I can actually see retirement down the road, and a lot of the baby boomers are also in the same boat. They're either very close to or in retirement. And there's two biggest worries that we have, and that is, do we have enough assets? Are we going to outlive our assets? Are we going to run out of money? And part and parcel with that, what do we do? How do we protect ourselves for the long-term care need? And, in the past, it was a nursing home need, and that's where long-term care insurance really started, as a nursing home need. But it's much more than that now. It's now home health care, assisted living, adult daycare, and this could be a big number for individuals and could easily spend down their assets. So anything we can do to help leverage those assets, we're finding that people are very open to those solutions.
Yeah, Mike, is it just a financial concern that retirees have, or are there other aspects to this long-term care that go beyond just the money?
Oh, it's just the money. It's the flexibility. I mean, it's more than the money, obviously. It's when you look at the different options for long-term care, you can self-fund, you can spend down assets and qualify for Medicaid, or you can purchase a product. Now, when we think about spending down assets, we lose control. If you're going to spend down to qualify for Medicaid, you've lost control. The decision making now for your care doesn't rest with you. So that's an important consideration as to why you'd want to look for a different option rather than spending down. also the toll that it takes on family members. I don't think there's probably anyone on this webcast that can't tell you a story about a horror story about a family member, a close personal friend, something that has happened where it has really taken a toll on family and friends to help care for someone who can't afford um, a regular long-term care type coverage to pay for it out of pocket. So it's much more than financial. It really, by having a proper plan, I like to think of it as bringing together the family more rather than really causing diversions. And just like if I think about when my parents were alive, I moved away from home. I was never local after I turned 21 and left college. I never went back to the area. My brother stayed there, so my brother was the caregiver. And you know what? That always causes a little bit of uh, it's an issue when you have, one family member that really shoulders that responsibility because other family members or siblings aren't around.
Yeah, Mike, you mentioned you're 60 and welcome to the club. I just turned 61 last week, and I'm going through the exact same situation with my own family. And we have the situation you just mentioned. My sister is nearest to where my surviving parent lives, and she shoulders the burden in just about every regard. And it is a bone of contention for sure. So, it is more than just the money, but it's certainly for a lot of people, particularly in the planning community, it comes down to how do we fund something? As you said, if you're not going to self-insure or spend down your assets, then you're looking at some kind of product. And so what are those products, and what are the different types of long-term care insurance that a person could potentially get?
Well, I mean, I'm a big proponent of traditional long-term care. The traditional long-term care plan, I think, can always provide the most flexibility for any situation. But the problem is we have had significant rate increases. We have had carriers that have pulled out of the market for a variety of reasons: low interest rate environment, increased utilization, mispriced products, et cetera. So we only have a few carriers in that traditional long-term care space. And the biggest hurdle to those sales are, well, what if I never need a benefit? I've been paying premiums for a benefit I may never receive. And a lot of people just don't like the thought of that, even though we pay our homeowners insurance every year and we hope we don't have a claim. But with long-term care, that is a hurdle. The other thing is, when we think about traditional long-term care, there is a fear of future price increases. And I will say that the newer products today are priced for certain lapsations, a certain interest rate environment. So we're being told by the carriers that we really shouldn't see those price increases in the future, but they could happen. So the lack of the guaranteed premium and this notion of, well, if I never need it, what happens? That sort of gets us away from traditional long-term care and people looking at it. So what has become very, very popular are what we call linked benefit plans, either attached to an annuity or a life insurance contract. And that allows us to get over those two hurdles. One is we can talk about guaranteed premiums in some respect. And the other is we can talk about, well, if you never utilize it, what happens? And generally that means the beneficiary gets some benefit or there's cash value that can be surrendered. So the linked benefit plans actually get over a couple of those hurdles.
Awesome. So I couldn't help notice in the title and in the opening to this that we were talking specifically about using qualified money to fund one of these types of linked benefit plans. Why qualified money? Why is that a important differentiator or point of distinction?
Well, that's a great question. I think what we're finding is that most assets that someone has, it's in qualified money. It's a 401k, a 403b, an IRA. Most of what we've saved during our working years have been in these qualified type plans. So when we try to analyze and look at, well, where do we find the money to help pay for a possible long-term care need? We're finding a disproportionate amount in qualified money. And there aren't a lot of really good options. We do have one carrier that kind of has figured that out. And, what I like about this is we see a lot of movement now from traditional IRAs to Roth IRAs. Why? Well, because some people are recognizing that perhaps we're in a pretty low taxation environment, that taxes could go up in the future. Why not take the tax hit today and then not have to worry about it tomorrow? So that's why an idea like this, it's been around for a while, but we're starting to see a lot more movement in this type of using qualified money for long-term care.
So I see. And what we're saying really, some people are not even familiar with the term linked benefit. And what you're talking about is we're taking a chassis like a life insurance policy, for example, and we are attaching to that some form of a rider or extra additional benefit that helps to cover for the long-term care. And we know that you can't buy life insurance with after tax or with pre-tax dollars, with qualified dollars, if you will. So that's where this idea comes in, is that if you've got your assets parked in qualified plans, then there's a way to be able to get access to those and use them to buy these life insurance or annuity-based products. And that's what you're going to be sharing, right?
Yes, absolutely, John. And not to be confused too with just regular life insurance with a chronic illness or a long-term care rider. The linked benefit, even though there's an underlying life contract or an annuity contract, it is marketed as a long-term care contract with life or annuity benefits on the side if never used. Whereas the life with a chronic illness or a long-term care rider, that's life insurance first. I need $1 million of life insurance. And oh, by the way, if I need to accelerate it for chronic illness, I can do that down the road. So the linked benefit really is marketed as LTC first. And generally it is a fully qualified long-term care type contract.
That's a really great distinction. Thanks for pointing that out. Why don't you go ahead and share the idea with us that you're wanting to share with the advisors out there?
Sure. And this is going to be very, very simple idea. And this is from a carrier. And what? Let me see here. Do I need to, can you see the ribbon up on top? Do I need to move that, get rid of that? Okay.
Looks good.
And I took the carrier name off because I like to kind of keep it generic, but for the most part, let's just assume that we have a female 65 and this person has 200,000 in qualified funds. I mean, obviously she has more than that in other qualified money somewhere, but if we look at 200,000 available that she wants to leverage for long-term care. This carrier, kind of, as I mentioned, has it all bundled. That 200,000 goes into an annuity. It goes into an IRA that then has a 10 pay into a life insurance contract, linked benefit life with long-term care. And what this carrier does is to help overcome, number one, it's paid out over 10 years to limit the tax implications of, we don't want that tax hit in 1 year. Number two, it's a 10 pay, so it avoids a MEC. But what the carrier also does is they have a 25% bonus that's payable. So if this client puts in $200,000, she will actually have $250,000 that will be then paid into this linked benefit life contract for $25,000 a year. Now, this money is taxable. Every dollar that comes out of a qualified IRA like this is taxable, but we want those taxes to be paid from somewhere else. We want the full $25,000 to go in. And in this particular situation, this $25,000 premium provides a guaranteed $218,000 face amount. So if she never needs long-term care, we've just taken $200,000 of qualified money. Now she will pay tax on it, but if she never needs the long-term care, she's got almost 219,000 of tax-free death benefit. And the way these contracts work is for a certain period of time, you're going to accelerate your own money. So if she does need long-term care, she has $8,700 a month, just over that, up to $8,700 a month for qualified long-term care payments for 25 months. After 25 months, her policy is exhausted, her death benefit is exhausted. But in this case, she has a continuation of benefits for life of 8747. So now with this carrier, we can have 50 months of benefits, 25 of her money, 25 of traditional long-term cares for 50 months. We can do a lifetime benefit. The beauty with qualified money like this is we can do a spousal benefit. We can do a joint contract. So there are a lot of different options, but just to give one example, this looks very strong. If we think about that 25% bonus that the carrier is given, that's really helping to pay some of those taxes. I have a case right now. We presented a 4-care annuity, which is a linked benefit annuity, very limited underwriting, to a couple last year. But the problem is they have most all their assets in qualified assets. Today, the producer called me and said, "Hey, is there another option?" Well, yes, we do have an option. We can utilize this approach. This is the One America State Life contract. Now, if you're familiar in the linked benefit space, One America is the only carrier that will provide a lifetime benefit. They do have linked benefit life, linked benefit annuities. On the annuity side, we may be able to find a different carrier that would be a little more competitive. But on the life side, they're the only ones that have this opportunity to use qualified money, that have the 25% bonus, and can also provide true lifetime benefits. So we like this carrier and this type of contract for this situation. Obviously, if you have individuals who can't get through the underwriting, I mean, it is life underwriting and long-term care underwriting, then we would have other options, and we'd look at, annuities, linked benefit annuities, or even with that limited underwriting, if there's an issue, we do have regular annuities that have a chronic illness doubler, if you will, that will double guaranteed income. And there's just a waiting period associated with that. So, whether it's me or any of the RVPs at E4, we're well versed in the variety of different options. And all we need is really a call to ask us, "Hey, what do you think? I got a guy, or I have a couple. Will this work, or do you have any other opportunities to help me find a solution?"
That's fantastic. I think it's a great idea, and I think, as you said, this is a time when we really need to be having these conversations. I think, we kind of look at things generationally. As you said, the previous generation, the biggest concern was nursing home. And now as we had more and more baby boomers that are moving through retirement, and even in some cases coming to end of life scenarios, the long-term care concern is really coming front and center. And I think is probably one of the biggest planning risks that is probably not getting the attention that it needs. It's certainly one of the biggest worries for the people that we're working with. And I think it should also be a worry for a lot of the financial advisors in terms of looking at their practice and what happens there. So great share. Thank you very much, Mike.
Thank you, John. I really appreciate the opportunity to kind of just spend a few minutes and go through this. I mean, let's remember, even if someone tells you they don't have a long-term care plan, they do. They just, they do have a plan, and it's going to be to spend down their assets. And, I get the question every now and then about, well, my client's worth $3-4 million. Why would they want to purchase this? They're wealthy enough to self-insure. They have enough cash. Well, we don't know that. We don't know how long they're going to live. And what I found in my experience is, you know, individuals who have some wealth, um, they knew when to leverage assets at the appropriate time. Nobody really became wealthy by not leveraging assets. When you look at business owners and how they take risk, well, this is a way. I don't see whether you have $500,000 or whether you have $4 or $5 million, why leverage like this doesn't work. And again, the we have a very conservative underlying life insurance or an annuity policy, whatever we're going to use. In this case, there's a tax-free death benefit. Is it a good investment? Well, again, the peace of mind, the ability to pay for lifetime long-term care benefits, and if it's never needed, tax-free death benefit. It's the beneficiaries will never complain about that. So I think that even if you have some assets, your clients have some assets, this is really a good thing to look at. And we see a lot of fee-only advisors that really don't look at this. Now's the time to really take a look at this. I have not seen any products on the advisory platform where something like this is available. So I think we do have a lot of people missing out on providing these solutions.
Yeah, really great points. Thank you very much. Listen, while we're waiting to see if there's any questions in the chat box, I would like to remind everybody today that this brewcast, as well as our entire library of episodes, are recorded and shared on the Brew blog at our website, www.e4.insurance, and also on our YouTube page. You can just Google E4 Insurance Services at Google, and you'll come up with our channel there. Now, for our giveaway, Mike, if you would, please pick a number between 1 and 25.
Oh, 14.
14. And today's winner is Patrick Bongen. Pat, congratulations. And be on the lookout for the complimentary CE voucher and the Starbucks gift card that will be coming your way from all of us at E4 Insurance Services. Looking into the chat box, I see one question here. How does an advisor, and this is to you, Mike, how does it change how an advisor manages the rest of his portfolio if he tries to incorporate an idea like this?
Oh, you know what? That's a great question, and I'm glad that was asked. Once you have covered, if you will, the LTC need or most of the LTC need, it actually allows the advisor to perhaps be a little bit more aggressive. And maybe aggressive is not the right word, but maybe searching for a little more yield, a little more return on the other investments, because without this type of plan, we're going to have to rely on pretty safe investments to cover the long-term care need. Now that we have this covered, we have it guaranteed, it's in place. Now we can afford to be a little bit more liberal with the investments for pure growth potential. So that's a great question, but it does give us, with that peace of mind of covering for the long-term care, we can be a little bit more dynamic on the investment side.
Thank you, Mike. There's a couple of other questions that have come in here. Here's one. Is this something that works for just a single person, or can you possibly get spousal coverage even under a single policy? How does it work if you're married and you want coverage for two people?
Sure, great question. Most of well, I won't say most. Some of the linked benefit contracts will allow dual spousal ownership. Both spouses can be on claim at the same time. This contract can absolutely have joint owners and joint beneficiaries for the long-term care. Both spouses can be on claim at the same time. We would always have to look at whether it makes sense to do a joint policy or two individual policies. And here's why. At the first death, there's nothing paid on a joint policy. So you may want, it may, your clients may want something. If, say, long-term care is not needed for one of the spouses and they pass away, the other spouse may want a long-term or a death benefit paid. So we would look at both options, but certainly on this type of product, we can certainly do joint. And there are some linked benefit annuities that will also allow joint annuitants and being on claim at the same time.
Fantastic. One more question, I think, is what we have time for, and then we'll have to let it go for the day. But what would you say are the key predictable outcomes that you stress with your clients when you're talking about this strategy? Is it the lifetime benefit that that they may be under what they actually need in their lives, for example? But what are some of the outcomes that you talk about that are
Well, the first outcome is the peace of mind that you have a plan in place, especially when you're dealing with spouses. My biggest concern is I know full well that my wife will outlive me. I don't have any expectation that unless she's hit by a bus, she's going to live much longer than I will, really because of family history. So I think the peace of mind, knowing that a plan is in place, especially for the spouse that you feel is going to need it the most, brings a lot of comfort. Secondly, it is absolutely one of those set it and forget it. It's done. It's completed. You don't have to worry about any price increases. The benefit, whether you use it, don't use it, it's there. And, I think it's also something that when I've spoken to clients directly, they like informing their children that they have this, because it also gives their children a peace of mind that, hey, you know what, mom and dad are covered. I've seen that happen. And so I think there's a couple of benefits there, not only whether we talked about earlier from the investment side, maybe being a little more aggressive on the other investments, but peace of mind and again, pulling the family together by having them recognize that, what, mom and dad have done something, so not to, cause and create havoc possibly down the road when they need something.
Yeah. Well, Mike, this has been a really great session. I really appreciate the insights and the input and showing us this wonderful example. And I'm sure that the listeners will reach out to the respective RVPs if they have any additional questions. Join us next week as we welcome one of our very favorite speakers, and that is Tiffany Markarian from Advantis Marketing. Any of the advisors listening in that has listened or had an opportunity to hear Tiffany speak know what a wonderful presenter she is, and some of the great wealth of information that she shares as you try and continue to build your businesses. So on next week's Brew, Tiffany is going to be sharing some of the key points on how to establish and nourish centers of influence around your business. So we'll look forward to that. Also, I would just point out that coming up on May the 4th is one of E4's premier events. And if you haven't registered for that already, go to our website, and up at the top tab bar, you'll see something called BBT, which stands for Building Business Together. And that is our annual financial security symposium that we run here. This year is going to be especially fun because it's on May the 4th, and we will be running with a Star Wars theme. So if you get a chance, we would love to see you there and meet with you face to face. And if not, we'll see you next week on The Brew. Thanks for joining us today.